It is late March. Everyone is scrambling to hit that 1.5 lakh rupee limit before the fiscal year window slams shut. Rushing to dump cash into random life insurance policies or 15-year lock-ins just to drop your immediate tax bill does not actually save you money. It traps your capital in dead-end products. Over the next 5 minutes, we are going to build your April tax strategy. We will calculate your exact 2026 liability, cut out the toxic insurance policies, and set up an automated system for real wealth creation. By mapping this out now, you stop reacting to deadlines and start executing a controlled, year-round strategy. Let's look at the math. Step 1 is identifying your baseline. For the 2026 fiscal year, the new tax regime is the default setting for all taxpayers. Here, both regimes start with a 12 lakh income. The new regime applies an automatic 75,000 rupees standard deduction. Then, the Section 87A rebate wipes out the remaining tax. Bottom line, under the 2026 new regime, your final tax liability is exactly zero. Yet, thousands of investors earning 12 lakhs or less are still rushing to drop 1.5 lakhs into ADC accounts this March, simply because they have done it every year before. If you do not calculate your exact regime threshold first, you are freezing your liquidity for absolutely zero tax advantage. That frantic search for deductions creates a perfect environment for aggressive agents to push the worst financial products on the market, combining life insurance with an investment vehicle. Check the policies you are being offered right now. If it is a 15-year locked endowment plan promising a 4 to 5% compounded annual growth rate, reject it immediately. Here's why. A 5% insurance return bar struggles to reach a horizontal line representing 2026 inflation at 5.5%. That gap is a negative real return. When money grows slower than the cost of living, you mathematically lose purchasing power every year. Life insurance is a critical tool for risk protection, but merging it with a panicked tax-saving intent guarantees wealth destruction over a 15-year timeline. To fix this, we replace the desperate March dash with a disciplined 12-month April strategy. Instead of writing a massive check at the deadline, you take that same 1.5 lakh limit and divide it into automated monthly installments. You start a systematic investment plan into an equity-linked savings scheme starting April 1st. This graph tracks two paths originating from the same capital over a 20-year timeline: a lump sum insurance policy growing at 5% and a disciplined ELSS SIP compounding at 12%. At the 2-decade mark, the gap expands to a 50 lakh rupee opportunity cost. Authentic wealth creation requires separating your tax planning from emotional deadlines and letting the market compound your capital in manageable, automated monthly increments. But even with the right investment product, there is a compliance step that can wipe out your gains: calculating your actual tax dues. If you have non-salary income, the law requires you to estimate your total tax liability for the year and pay at least 90% of that amount as advance tax before the March 31st deadline. If you miss that 90% threshold, you trigger Section 234B. This imposes a 1% monthly penalty interest on your shortfall, actively eating away at the top of the returns you just earned from your ELSS investments. Purchasing a tax-saving instrument does not clear your actual tax debt. Managing your liquidity to cover advance tax on time is non-negotiable. That is the complete April strategy. You calculate your true taxable base under the new regime, reject low-yield endowment plans, automate your ELSS SIPs, and clear your advance tax. The difference between the panicked investor stepping into a 15-year insurance trap and the investor holding a zero tax liability under the new default regime comes down to running the numbers today. If your income is under 12 lakhs and your effective tax just dropped to zero under the new rules, let me know in the comments below. Also, head over to the community tab on our channel right now. We are running a live poll asking if you have officially made the switch to the new tax regime, and I want to see your vote. True financial freedom is not achieved by writing a desperate check at the deadline. It is built through a calculated strategy executed tomorrow.
Let's discuss that in the comments section. And as always, thanks for watching Alux Life. Subscribe for more.